Stocks Explained for Beginners. Have you ever stopped and thought, am I actually doing okay with my money? Like, how much does the average person really have saved for retirement? What do most people earn in a year? And are we all spending way more than we should? We're about to break all that down, because once you see the numbers, you'll have a way better idea of where you really stand financially. Hey everyone, my name's Matt, and I talk all things money, saving, investing, and building financial freedom step by step. If you're ready to take control of your finances and make smarter money moves, hit that like button and subscribe. Let's get in. What stocks really are. Let's start with the basics. When you buy a stock, you're actually buying ownership in a company, even if it's just one small share. That share means you own a fraction of that business, and if the company grows and makes money, your investment can grow too. Stocks are listed on something called an exchange, places like the New York Stock Exchange, NYSE, and NASDAQ. These exchanges are like giant marketplaces, matching buyers and sellers in real time. Prices move up and down every second depending on how many people want to buy or sell a stock. If more people want to buy, prices go up. If more want to sell, they go down. That's the core of how stock prices change. It's just supply and demand, nothing mysterious about it. How the stock market works. When people say they're investing in the stock market, they're really talking about buying stocks that trade on these exchanges. The market itself is just a collection of all these companies being traded. Most investors don't deal directly with the exchanges. They go through brokers, which are basically middlemen. In the past, you'd call a human broker on the phone, but now it's all online. You can use platforms like Charles Schwab, Public, or even Coinbase. Opening a brokerage account takes around 15 minutes. It's basically like opening a bank account. Once your account is ready, you can start buying shares with just a few clicks. When you can trade. Stock trading in the US happens from 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. That's the official trading day. But some brokers offer pre-market and after-hours trading, which means you can buy or sell a little earlier or later than the usual hours. These extended hours are useful if news breaks before or after the market closes. For example, when a company reports earnings late in the evening. You've probably heard people say things like, "The market is up today," or "The Dow fell 300 points." But what are they talking about exactly? They're usually referring to market indexes. Think of them like scoreboards that track how groups of stocks are performing. The three most famous indexes are the S&P 500, which tracks about 500 of the biggest US companies. The Dow Jones Industrial Average, which follows 30 large, well-known corporations. The NASDAQ Composite, which includes thousands of companies, especially tech giants like Apple and Microsoft. When these indexes go up, it means most of the major stocks they track are rising. When they fall, it means the opposite. Many investors use these indexes as a benchmark to measure their own portfolio's performance. You can even invest in an entire index through index funds or exchange-traded funds, ETFs. These funds hold all the stocks within that index, giving you instant diversification without needing to buy hundreds of companies individually. Investing versus trading. There's a big difference between investing and trading, and it's good to know which side you're on. Investing is long-term. You buy stocks or funds, hold them for years, and let them grow. Think of it as planting trees. The longer they grow, the more shade or money you'll have. Trading, on the other hand, is short-term. Traders buy and sell frequently, sometimes several times a day, trying to profit from small price movements. Some are day traders, constantly in and out of the market. Others are active traders, making dozens of trades a month. Trading requires a lot of time, skill, and focus. You need to understand charts, trends, and technical analysis, basically studying price movements to guess what might happen next. Bull and bear markets. Now, let's talk about two animals you'll always hear about in market talk: bulls and bears. A bull market means stock prices are rising, people are confident, companies are growing, and investors are buying. It's a time of optimism. A bear market means the opposite. Stock prices are falling, and usually by 20% or more. It often signals fear and uncertainty. But here's some good news. Bull markets last longer than bear markets. Over the long term, the stock market has always recovered and kept growing. Take the S&P 500, for example. It fell into a bear market in June 2022, but bounced back by October 2022, entering a new bull market that lasted through 2024, hitting all-time highs in May 2024. Historically, when you include dividends and adjust for inflation, the S&P 500 has returned about 7% per year on average. That means if you'd invested $1,000 30 years ago, you'd have roughly $7,600 today. Crashes and corrections. The market doesn't always move smoothly. Sometimes it dips sharply. That's called a correction, which is typically a drop of 10% or more. When the drop is fast and steep, it's called a crash. A crash sounds scary, but it's not the end of the world. Remember 2020 when COVID-19 hit? The market collapsed in March, but by August it was already breaking new records. The key during downturns is not to panic. If you sell when prices are low, you lock in your losses. Most investors who try to time the market, selling when things look bad and buying when they look good, usually end up worse off. The best approach? Stay patient. Keep your investment steady. Markets fall, but they always recover over time. The importance of diversification. One of the smartest ways to protect your money is through diversification. That just means not putting all your eggs in one basket. If you invest everything in a single company, you're taking a huge risk. If that company fails or faces trouble, your whole investment could vanish. But if you spread your money across different companies, industries, or even countries, you reduce that risk. Diversification helps balance out the ups and downs. If one stock falls, another might rise. Staying focused on the long game. The hardest part of investing isn't understanding it, it's managing your emotions. The market will rise and fall, sometimes dramatically, but history shows it keeps trending upward. Trying to predict short-term moves rarely works. Even the best analysts can't get it right all the time. Instead, focus on time in the market, not timing the market. The longer you stay invested, the more your money compounds. Dividends get reinvested, and your gains start earning their own gains. That's how wealth builds quietly over years. So if you see a scary headline about a market drop, take a breath. Remember, crashes come and go, but patience pays off. That's the real story behind stocks. You're not gambling, you're owning. Every share represents a company, a team of people creating products, services, and value. Whether you're starting with $10 or $10,000, what matters most is getting started and staying consistent. The stock market rewards time, not speed. Investing isn't about guessing the next hot stock. It's about understanding the basics, building a diversified portfolio, and letting time do its thing. So, what do you think? Are you ready to start your investing journey? Let me know your thoughts in the comments below.